Hey guys, Jay here at smartopening.com. Are you ready to learn? We are going to talk about preferred returns. This is 100% relevant only if you're dealing with monthly distributions, and there's some interesting things here to think about for waterfalls. So let's look at two scenarios. One where there's an IRR hurdle and one where there's a simple pref. Now the simple pref could compound, it could not. The difference still exists here. And the timing of the cash flows is going to be very important. So, um, this often comes up in real estate, but it can come up in all kinds of different industries with joint ventures, and specifically when there's investors that have a preferred return rate. The biggest initial thing, especially if it's monthly periods that you're calculating the returns due, is the rate an internal rate of return rate, or is it a simple preferred return rate? So here we have two scenarios, and I've done a little bit of the work here, but not much. We're going to do it live, so or right now. So let's say you invest $800,000 into something, and there's an 8% pref. So how do we calculate what's due in each month? Well, here's the biggest trick. That's not a trick, but here's why it can be so complicated to think about. An IRR rate is time weighted. A simple pref is not. So when I go to calculate how much is due in month one, in order to maintain, remember an IRR hurdle is solving for an 8% internal rate of return. Meaning if I discount these values back to zero, I'd have to discount them by this rate in order to get to zero. So we're going to calculate how much is due to get that, and you'll see the differences. and the main reason why this exists is because cash flow in month 1 is better than cash flow in month 12. When you're looking at internal rate of return, it cares about time. Simple pref doesn't care. Doesn't matter if it's the same amount is distributed in month 1 through 12 and it equals the same amount. If you got it all in month 12 or evenly throughout the year, it doesn't matter. That's not given any weight. So first thing, let's calculate the return due for internal rate of return if we're going to solve for an 8% hurdle rate. And this just means this is the compounded rate you're going to receive, so that you get that plus your return on capital, and that equals this 8%. So here the calculation is a little tricky. So in month 1, we don't just take 8% divided by 12. That's incorrect. That will give you an internal rate of return that's higher than 8%, and I'll show you down here when we do it. So we need to know what compounded rate needs to be calculated so that by the end of month 12, when we run an IRR calculation, the IRR is 8%. Now, since the cash is time weighted, monthly cash in month 1 is worth more, meaning that you, as a general partner, you don't have to distribute as much cash to the LP as you would a simple pref, and that's a big point right there. If it's an IRR hurdle, because they're valuing those monthly cash flows higher if they get it sooner. So it's actually a lower distribution amount to reach that hurdle rate. And again, this is for models and things when you're doing a monthly calculation. I do one here in this model. I'll show you at the end. But let's do the calculation. So what's due? Well, we take simply 1 plus the rate raised to 1 divided by 12 minus 1. So this is the compounded rate of return that we need to give each month so that the IRR is equal to, and we'll do this so you can really see it, equal to 8%. And notice how that's different than on this one down here, a simple pref. You could do 8% divided by 12, and that's completely acceptable. See, that number is higher. So if it's a simple pref, you have to pay more because there's no extra value given to a cash flow received in month 1 compared to 12 or month 40 or whatever. Okay, so we calculate So this is what's due. And we're going to assume that this is being paid each month. So there's no compound of the capital. So let me lock this. There's your cash flows paid. So you're paying those cash flows. We'll make these positive values. And then at the end, you're getting your money back. So the question is, here's the total cash flow. It's this plus that. Okay. Now, I believe this has to be in the 12th period. It might be the 13th. Let's double check real quick. So the actual IRR we get. And to do this, you can either do an X IRR and have the actual dates here of each month, or you can just do IRR of each period of the cash flows. And that's the monthly rate. And then we want to convert this. So that's our monthly IRR, but we're solving for an annual rate because it's usually it's usually stated as an annual rate. So our 8% internal rate of return annual. So what do we get here if we're trying to figure out, well, we got paid this amount each month. We got our money back at the end. So what was our internal rate of return on this deal? Well, we take the IRR of that, and then you go to convert it. You go 1 plus this rate. And now you're raising it to 12 minus 1. And there you go. 8%. Look at that. So we got 8 decimals there. That's exactly 8%. So we solved for this, but look how much actually, if you look at the nominal amount, look at how much it was. Well, actually, if you take the sum, we got $61,000 divided by our initial investment. Well, that's not 8%. That's, if we take decimals, that's 7.72%. So over a year, I got 7.72. So what's the deal? Well, we're solving for internal rate of return. So these cash flows here in month 1, 2, and 3, and 4 are worth more than just getting a one lump sum at the end. Here's another interesting point. Let me show you this. So if we go, let's say you don't get paid. So your balance is, you start with 800,000. The rate due is this plus this amount. So here's what's due in theory. Let me switch the calculation here. So really your balance due as the LP is 800 plus you're owed 5,000. It's not paid. So now it's compounded. And now, if we compound that, okay, now this is the new basis. So we go period 2. Well, let me do ending balance. Is that beginning balance? Now the amount due is this times the rate. And now you go, this plus this. There's your ending period. Let me format these. You can probably guess what's going to happen, but let's do the math out here. Now, look what happened. If you don't pay distributions out and this preferred return or this internal rate of return compounds, we're at 864, which is what? If you take this against your initial investment, 64,000, if you do that divided by this, whoa, what's that? We got back to our 8% somehow. Now, isn't that interesting? So there, that kind of proves to you, and you can see that's a hard 8% there. That proves to you that we did the correct calculation here in showing that this is the rate that you got to compound the initial balance by in order to get 8% at the end of the year. So you can see the actual amounts here, if we compound, they do equal the same as, well, we have this one. I did this all in one calculation. This would be this times your initial rate. So if you add up all these, you're at 64,000. That is the same as the simple pref version. Even though the simple pref you're paying each month, you're still paying that amount. Here, if we only give the cash in month 12 and we're not distributing these cash flows and it's just compounding, then yes, you get your amount due is the same as if you were to do it on a simple pref. Because, well, you didn't give any money, so there was zero weights in the first 11 months. In month 12, you actually paid the full amount due, which is 8%. So that's why, I don't think LP or GP should be so afraid of the IRR hurdle because, if you think about it, the amount due is less than a simple pref. But if you don't pay it and it starts compounding, in month 12, you are paying the 8% amount, the same as if you were doing it down here, which we haven't, done the math on this yet. I'm about to. But if you can produce cash flows right away, those cash flows are valued higher. Okay, so hopefully that helps some understanding. Let's go to the simple pref here. So here, remember, we're just taking the rate divided by 12 instead of doing this other complex calculation. And we're saying, okay, take this times here. This is the amount due. Now this could be even worse for the GP if you're doing this calculation and you're compounding. Then it's even more if you don't have cash flow. So for example, your cash flow stream is going to be, here. And then if this is 0, then this is going to add to it. So, the capital balance, let's just do the capital balance, will be here. This is the return calculated. So now you owe here. This is the beginning balance. You're adding, and so forth. And now look what happens. Now you're paying here. Oh, whoops! I need to compound that. So, well, let's do the non-compounding first. So assume that it's a non-compounding rate. Well, then you're just paying $5,333, which is your $64,000. Even though you're paying it in month 1, 2, 3, and 4, and 5, and 6, and so on, you're not getting, it's not that lower 5,147. It's the 5,333 because it's a simple pref. So if we calculated the internal rate of return, we did the internal rate of return on these cash flows for the investor, watch this. So you did this, you paid this each month, right? And then you paid them back at the end. Well, now what's the internal rate of return? Well, it's actually going to be higher. Sorry, let me this plus that. So we get one stream to reference. Now you're at, and then we do 1 plus the rate because we got to convert it to an annual rate from a monthly. Raise to 12 minus 1. Now you should be a little bit higher. Yeah, 8.3%. So if you just do the rate divided by 12, and that's what you're calculating, you're actually giving an internal rate of return of 8.3. Again, this is only relevant when you're doing monthly distributions. This is not really relevant on annuals because you're not having that granularity in between the years. If you're doing monthly, then all this matters. Okay, so 8.3, so that's higher. Again, we're doing the same rate here. Now let's say you don't distribute during the year and you compound. So if you compound, now we are at, so we start at 800,000 capital balance. We had 5. Then we have 805 due, so 805. And then we calculate, make sure this is a reference. Then we calculate our new balance based on the rate times that new balance. And then our ending balance would be this plus that. And you go on. Whoops, that's down here. And now you can see this rate due, which was the total amount. Let's just sum up. It's this plus all of these amounts. 66,000. So that's the worst possible case, is the most money you got to pay out, and you're paying monthly, is when you're doing a simple pref and you're compounding and accruing the unpaid returns. Now look, you're stuck paying 66, which is more than this. It's more than your simple non-compounding amount, which would have just been, this, which was, I believe, the 64. It's way more than the internal rate of return, where you're actually sending out distributions each period, which is the best, 61,000. And note this, see the actual total against this is only 7.7, but if you take the IRR, which, where do we calculate that? Right here. The IRR is actually 8%. This would be more of the cash on cash, you could call it. Cash on cash return. This is internal rate of return. Okay, so simple pref, what was I doing? So this is the worst case. And then, in that, then the IRR the LP is getting is, let's see, so you're doing, your cash out would be this, and you're not paid until the very end, and then at the end, you're paid this amount. And then we do an internal rate of return of that over the year. And plus the rate, raise to the 12 minus 1. Now you're at 160%. Now let me make sure I did the math right there. So 12 periods, you're not getting anything. And then at the end of the 12th period, you're getting this lump sum, which is this compounded amount, which was all of these. 866.4, that. Yep, that's... Why does that seem so high? 1 plus the rate raised to 12 minus 1. This one, 861. Why does that seem so high? Am I missing something? 1 plus the rate raised to 12 minus 1. 1 plus the rate. Yeah, I mean, so that's the annual rate. Let's just double check. It just seems so high, but I mean, it makes sense that it's higher because you're compounding at the simple. Yeah, that's it. Now, if this were this, right? If it's 805, now how? Hold on a second. So I told you, ready to learn or get confused, one of the two. Is this divided by that? Now how are we getting... And exactly 8% on this. Am I losing it? So this is 1 year's period. So if you're getting 5,000 back, this is your monthly IRR. Oh my goodness, sorry. Okay, sorry. It has to do with Excel. Okay, let me undo. So here's the thing. If you don't have a value in here, Excel doesn't count it. So that means it was basically thinking you got 800 out and 866 in the next period. So we got to put zeros in here. I forgot about that. So there you go. So 8.3. Okay, that makes about 160% IRR. It's 8.3, so that's the best for the LP, worst for the GP, and that would be a compounded pref. That's compounding, accruing the return, and you're paying. You're getting that each month. The best situation for the GP and worst for the LP, meaning the lowest money, would be the IRR hurdle, where you're getting paid monthly. Now, not necessarily the worst, because you are getting that money, meaning you can reinvest it over the period, and that's why that's time weighted. You're getting money back sooner. Because of that, you're getting less overall, but you are getting it sooner, so you can reinvest it. Okay, man, I'm sorry for that last bit. I really wish I would have caught that so you didn't get too confused, but we got to the right idea in the end. So, okay. Whew. Now I think that's about everything I really wanted to go over. So that's all about monthly distributions for preferred return waterfalls. Mostly dealing with real estate, but it could be other types of industries with joint venture preferred returns. Um, and that's why it's really important when you see the terms. And there's a lot. I've done so many different waterfalls because everyone has different terms. Simple pref versus IRR. Is it a simple? Does it compound? Does it accrue? Well, obviously, if it accrue, if it's accruing, it might compound, it might not. But um, you know, how is this convention being calculated? And it's all dependent on the deal. It's how the language is worded depends on how it will go. And don't, like, when I say better or worse, I'm really just saying what's the, and I was just doing that in reference to the actual total cash flow for the year that's paid to the LP from the project. And so when I talk about what's best for the GP versus LP, well, technically, if the LP is getting that money earlier, that's good for them too, because then they can do stuff with it. So it's not necessarily worse, but I just, a lot of people get scared of the IRR hurdle because they see that compounding rate, and they might not understand the mechanics that we just went through with how this works. If you look at the model here, this waterfall is monthly, and you can see that these are the hurdle rates, and we're just using that same. This is set up a little bit different formula, but it's the same idea. We're converting the annual rate to a monthly compounded rate to calculate what's due to the LP, and as they go through the hurdles, the promote is happening for the GP, and it's all calculated on a monthly basis. You can see here the final annualized IRR is also doing that formula with the 1 plus the rate raised to the 12 minus 1. And to solve it, you can see these are monthly periods. If we take this IR for the LP and plug it into the discount rate for the LP, that should make this net present value turn to 0. So if I do that, you see there. That's a good way to check and make sure the math is actually making sense. So by definition of what the internal rate of return is, monthly cash flows, this is correct. And I spent a lot of time getting to the point where I can explain it like this because it did not come right away. It took some time to go through and understand this. Okay, well, I guess that's all I got. If you want to buy some templates that have this kind of math going on, mostly it's going to be, if you go to smarthelping.com, the real estate, you go to the homepage, the real estate section. All of these models, some of them are annual, some of them are monthly, so you get all the different calculations here that you can use as references. I also include some waterfalls in the real estate bundle. If you want all of the waterfalls, though, which I have many, you can go back to the home page. You can go to joint venture waterfalls and explore all of these. And you can buy the bundle or individual templates as well. All these calculations have been done in here. There's some that are annual, some that are monthly. We go to Super Smart Bundle, and if you want all the templates on the site, you can buy here for $500. It includes everything, and I don't just have waterfalls. I have full startup financial models for a bunch of different industries, many hundreds that I've built over the last decade, all in Excel and all fully unlocked and editable. So check it out. You can also hire me. My rate's $275 an hour, pay as you go. Usually my turnaround times are pretty quick, 1 to 2 days. I run a pretty tight ship, and I don't let things hang. So usually I'm available, and you can contact me, email me about potentially building something if you want to do that, or even I customize. If you want to buy a template and I can customize it however you need, that's fine too. Alrighty, like and subscribe, and I'll see you on the next one.